In focusing on the younger generation, something that I want to hit on that I haven't seen getting too much coverage is the changes that are made to the 529 plan. For anyone not aware, a 529 plan is a tax advantage plan geared towards educational spending. The recent expansion of eligible expenses for the 529 plan now includes things like homeschooling, professional credentialing, and even tutoring. And this next feature makes me very excited. As you may or may not know, I'm a major proponent of saving. Children born between the dates of January 1st, 2025 and December 31st of 2028 are now eligible for a savings account geared towards children, similar to an individual retirement account or IRA. These new accounts, set to launch in 2026, will receive an automatic $1,000 government contribution and will have $5,000 contribution limits per year. These accounts are set to be like individual retirement accounts for those under the age of 18, which have a variety of differences from current savings plans for children. And what makes these accounts particularly unique is the funding sources that are allowable. Not only can family members contribute, but employers can contribute, government sources, as well as nonprofits are also allowed to contribute money to these accounts. For example, an employer will be eligible to contribute up to $2,500 per year for a dependent of one of their employees, and this will go towards the $5,000 contribution limit, but it will not be counted as income towards the child. This feature distinguishes these type of accounts from other IRA-type vehicles, where employer contributions are usually counted towards income. Any funds contributed are essentially locked in until the child turns 18, at which point these accounts automatically convert to a traditional IRA. So from that point on, the new account then follows all the same rules as a traditional IRA as far as contribution limits and withdrawal restrictions are concerned. Also important to note that investment restrictions may be imposed on these accounts in an effort to try to protect the child from investment risk over time. Once the account converts to a traditional IRA, however, at age 18, the child has free range to invest in whichever manner they want. Let's look at how this might work in practice. A grandparent contributes $5,000 annually on behalf of their grandchild from birth up until age 18. In addition, the account receives a starter from the government of $1,000. Over the course of those 18 years, this amounts to about $91,000 in contributions and hopefully experiences growth and compounding interest over time, which could grow substantially from there. And while the exact outcome can vary for a multitude of reasons as far as the account is concerned, this could end up providing a wonderful base by the time the grandchild ends up reaching retirement age. In addition, one other thing to note, the contributions to these accounts do not affect those that are making the contributions, whether from the parents or the grandparents, if they are contributing to retirement plans of their own. This means theoretically, you could help fund your grandchild or child's future without jeopardizing your own retirement savings.